Come on in, sit back and relax. You're listening to the Wealth Tech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. This podcast features interviews, news, and analysis on the trends and best practices all around with management technology. My guest today was Alex Goodwin, CEO and co-founder of Bridge. We spoke about the problem, legacy tech and manual workflows and alternative investments, the solution, which could be Bridge's AI native operating system, their MVP and product strategy, their competitive moat and market timing. We talked a bit about how Bridge's AI isn't autonomous because it flags low confidence outputs for human review. Now, we know AI still has serious issues with accuracy, which is a critical factor when deciding on which AI tools to integrate into your tech stack. Whether your tech stack is well designed or a haphazard collection of software, it definitely needs some work before it can support any of the current AI tools. You need a plan for cleaning up your data and optimizing your tech ecosystem so you can take advantage of all the benefits that AI has to offer. Ezra Group can help turn your tech stack chaos into a competitive advantage. Our 60-day tech stack reboot is designed specifically for RIAs looking to take the first step in gaining control over your tech infrastructure without breaking the bank to do it. If you want to free your firm for exponential growth, you need to run, not walk, to our website, ezragroup.com, and click the golden Contact Us button on the homepage. Whether you're struggling to scale your business or wondering why your management reporting takes so long to generate each month, the experienced team at Ezra Group will help you design, optimize, and future-proof your infrastructure. We know what works and what doesn't. Visit ezragroup.com to learn more and schedule a free strategy call. All right, now a few standard housekeeping chores. Please subscribe to the show wherever you listen to podcasts. Check out our sponsor, the Invest in Others Charitable Foundation at investinothers.org. And if you are a software vendor in the wealth management space, please make sure to register your product with our Wealth Tech Integration Score vendor portal, ezragroup.com/register, so that your product's Wealth Tech Integration Score will always be up to date. Now, let's kick this thing off.
All right, I'm pumped to introduce our next guest. It's Alex Goodwin, co-founder and CEO of Bridge. Alex, man, it's great to talk to you.
Likewise, great to be here. Thanks for having me on.
Terrific. This is great. Where are you calling in from?
Calling in from Boston today, which is currently home base. It's a nice, balmy, 30 degrees and cloudy here. So
I was going to say a stiff, a bitter, or a brisk day in Boston. Probably shorts weather now when it goes over freezing.
Well, so I'm originally from the West Coast. So when I see people in shorts, I know they're really from Massachusetts. And meanwhile, I'm bundled up to, the fullest degree possible. So they know I'm from here.
My COO lives in St. Petersburg, and her kids, when it hits 69 degrees, they're like, "Where's the parka? Where's my hat?"
So that's right. It's amazing how much we adapt and adjust to our environment. So
there you go. All right, cool. So let's jump right in. I'm really excited to talk to you about what you guys are doing. But if you could start us off, please, sir, with a 30-second elevator pitch for Bridge.
Yeah, absolutely. So at Bridge, we are building the new operating system for private markets. And really what that means is we want to augment and automate the workflows that are required to participate in the private markets ecosystem. Historically, this is a group of tasks that have been highly manual, tedious, and disparate. And we are trying to centralize and streamline that using modern technology to allow folks to spend more time on the more important activities that they could spend their time on.
We all want to spend time on more important activities. It goes without saying. So give us I'm always interested in the origin story. There's so many alternative investment platforms out there. I don't need to name them. We've had them on the program. We talk about them a lot. Why do we need another one? What was the specific gap that you set out to address?
Sure. So maybe rewinding all the way back to the beginning. So
go back to the beginning. It's a very good place to start.
Yeah, absolutely. So the beginning really is myself and my co-founder, Io, meeting in business school at Harvard, which is what actually brought me out to Boston initially. And at the time, we were both coming in independently, thinking about ideas in the space, having an experience set that was quite similar to each other in private equity investing previous to school. And I think what happened was we both came in, and to your point around alternatives platforms, we had seen and heard about many of them. And I think most of them at the time had focused primarily on access. A lot of it was around how do we get more people into alternatives? And it was mostly from democratization, right? Is the
which
perfect
is
way to.
a buzzword I don't like.
Well, and your word's not mine, Craig, but to be fair, I agree. That is the word that everybody talked about, right? That was the
Not that
bubble.
we're against democratization, but just the way it's used by everybody,
It's
for all
overused to
kinds of
be
stuff.
sure. It
Yeah.
is overused to be sure. And I think that whether or not the word is a good one to describe it, it is the word that everybody was talking about. And I think that was, the likes of iCapital Case, et cetera, all the names that you know. And I think what we uncovered as we talked to more people in the ecosystem from, GPs where we came from, all the way through LPs and the allocators who provide the capital that goes into those funds, we found that the digital infrastructure layer was the area that had been largely ignored. And all these people were excited about access and feeder funds and lower minimums and all these things, but people weren't quite grasping how much more difficult it is to participate in private markets investing. And so I think as we got deeper into our work and our excitement around that space, right around the same time as GPT came out midway through our time at Harvard, and we were starting to think a lot about how that was going to upend industry really across the board. Of course, for us, we were getting excited about the applications of that technology to what we believe is fundamentally a data problem at its core. And this technology being particularly well suited to deal with complicated, messy, non-standardized data that we think sits at the center of what makes private markets hard. And so that was the opportunity we saw that was underserved in the marketplace by platforms that were focusing on alternatives, but either from an access standpoint or maybe from a manual kind of managed services perspective to solve some of the pain points that we think now can be automated with technology.
Excellent. So, talking about the digital infrastructure layer, what makes everyone's got a digital infrastructure layer. That's nothing new. So, what is different about yours when it comes to integration, transparency, and scalability?
Absolutely. I think that, and I'm going to try to avoid using this word too much as well, because I don't want it to be buzzy like democratization. But I do think that building natively with AI and machine learning today is a very unique moment in time that we're in. And I think it's allowing us to build a system in a very different way to the way that others have built their systems. And so for us, what that means is we've effectively built something that mirrors human behavior, right? So if you think about how we got going, myself and Io actually coming from this world and intimately knowing and understanding this data, the very beginning was us spending a lot of time manually looking at documents, pulling data points out of those documents, structuring it the way we would do it if we had been tasked to do it as an analyst or associate in a previous job. And ultimately, it was creating that ground truth knowledge base and then applying that level of intuition and insight into modern AI and machine learning engines and building a lot of custom tooling on top of what are the foundational models that everybody has come to know and love, that has created a system that actually acts and mirrors human behavior and learns like humans do, right? And that's a very fundamentally different approach versus building, technology interfaces that are ultimately underlied by human activity. Ours was upfront human activity to build a knowledge base that can train something that can self-sustain versus let's actually just outsource and have humans do work that we believe should be done by machines.
All work could eventually be done by machines.
Interesting. And it's a good topic. And I'm glad you went there because as it relates to the wealth ecosystem and advisors, I would actually challenge a little bit there that I think that one thing I really don't think will go away is the human touch of an advisor and a client, right? I really think that that will not be replaced by machines. I think what will happen instead is I think that the bar will be raised significantly on what is expected of an advisor and what good looks like, because the savvy advisors will adopt technology to augment and automate workflows that can be done by machines. And what that will do is, going back to the previous point, free up their time, free up what might be 30, 40, 50% of their time today to do what I mentioned as being higher value activities. Well, really what that looks like is, I think, going above and beyond in the way that they interface with clients. How deep do they go into analyzing the information and providing differentiated value add? How much time do they spend adding value in other parts of their clients' lives beyond maybe just the financial reporting components or, the advisory meetings that they have once every, so often, right? So I think that's where you're going to see a change in what's expected from folks And I think that human touch component won't ever go away, but folks are going to have to employ technology to unlock that capability.
I agree and disagree in that everyone says that. It's a common trope that we hear at every conference. Anyone who's asked about AI, especially CEOs of firms, who always say, we're not replacing advisors. But when it comes right down to it, when AI gets to the point where it can do everything an advisor does, they'll be replacing advisors. They just won't talk about it. They won't hire as many. There'll be more digital, self-directed, what they call self-directed channels that'll start to grow, and they'll get smarter. But I do agree that the bar is already being raised in a similar way to the robo-advisor trend. That robo-advisor didn't put too many advisors out of business, but it did raise the bar that you couldn't charge 100 basis points and just build a basket of ETFs and rebalance it once a year. You weren't going to get that anymore since I can get it for 25 basis points from Wealthfront. But I think AI is very different in that a robo-advisor couldn't mirror what an advisor did on the human side, where AI can do that. And we're already seeing AI be very empathetic, people, telling their life stories and all their secrets to AI. I mean, as sad as it is, people are killing themselves because AI tells them to, right? You never heard a robo-advisor kill anybody. It's going to be a much bigger threat, I see. So
you're absolutely right. And I do think that I agree with you in the sense that I think it may dwindle down the number of advisors that are needed to do the same level of client engagement, right? Because to that point, they'll have more time to spend with more clients, right? Any given advisor, if firms are utilizing and embracing technology in the way that I think they probably should be today and going forward.
So let's talk a bit about, I want to congratulate you on just this year, you raised a $5 million seed round led by Justin Wiz of Thicket Ventures, who I know. And that's great. Congratulations. So how does that change the way you're building this firm when you started out, again, you and IO, and now you got $5 million at the bank? How does that change the way you're focusing on this new firm?
Yeah, first off, thank you. That was a great moment for us, and obviously an exciting one for the early phases of our journey here. And I think, what it does is it unlocks our ability to, I think, scale the initial proof of concept and traction that we had found early on. Because I think if we rewind a year ago, even at that point, the team was IO, myself, and our very first hire. Our very first hire, who helped build the platform with us from scratch. He came to us from Plaid, where he had been running the machine learning platform there. And at the time, we basically, right around this time last year, had the first MVP version that we took out to the market for pilots, right? We were just beta testing and hoping that we would get some folks to give us the time and use it and give us feedback, let alone maybe convert into revenue generating contracts at some point, right? And so I think the big change now has been that we've been able to go from 3 people to 9 people now doing this, and we've been able to go from a handful of pilot customers not paying to a solid customer count on paying contracts that are real large enterprise level customers in some cases. And so I think it's just been a big unlock for us in terms of knowing that we were onto something. And not only getting the validation, which is probably more of a secondary derivative benefit, but more unlocking our ability to continue doing this and doing it for more people. And also starting to expand the roadmap into the other parts of the vision that we're excited to tackle that build on top of what we've done, I think, quite well with product number 1.
Speaking of product number 1, how did you decide what was going to be in the MVP? So that goes back to what you saw as the gaps in the market. So what specific features did you build out first and why?
Yeah, it's a great question. We thought a lot about this, right? Because in some sense, distilling down to a product wedge to focus on was one of the hardest things that IO and I did early on. We had the big vision, the end-to-end operating system that was going to be this great one-stop shop. We sort of had really honed in on what that value prop was going to be long-term. And the hard thing was figuring out where to start. And I think what we realized is that the thing that would unlock the entire roadmap for us is if we could get access to what is a very proprietary and hard data set to get access to in the way of private markets positions and data. And the only way to do it is by solving a tangible pain point that requires you to have access to it, right? Period, stop. That was kind of what we landed on. And so we realized, okay, if we can go to the back office of the allocator, the groups that are responsible for collecting all of the information on behalf of their clients across all the places where it lives and getting those documents into a central system, and categorizing that into a capital call and a distribution and a K1 and a quarterly statement, and then getting the various data points from those documents that are needed to ultimately take action with them, right? Capital calls got to get executed by a due date. Quarterly reporting has to get out to the client on time, so on and so forth, right? We knew that if we could automate that workflow front to back and save so much time and pain and manual tedious work for our customer, we would ultimately be building an engine using the raw source data and documents that unlocks the rest of the roadmap and solve a pain point while we do it. And so that's where we started, and that's where we found a lot of very quick traction in the marketplace. I think that there were only a small handful of folks doing that and doing it well in the market, and we had a different approach to how to do it, and that obviously gave us, I think, what we believe is a competitive edge in various ways, and that's allowed us to win some great business so far. And ultimately now we think that we're well positioned to tackle the rest of that roadmap because of what product number one started as.
Cool. Thank you for sharing that. I really appreciate it. So when we're talking about building a new product from scratch, what's stopping the next Harvard Business School class from going, hey, alternative investments are a big problem. We've got these great tools. We can just build them from scratch. And they've got 2 years ahead technology than you built on. So the legacy problem, innovator's dilemma, never stops. How do you guard against that? What's your moat of what you're building?
Yeah, great question. I like to think it wouldn't be another HBS student just out of camaraderie, maybe a GSB student or a Wharton student. I could understand that.
Yeah.
No, jokes aside, I think that, in some sense, I think of this a lot like the .com era, where I think there were folks that fell on the pre.com side of, retail and business and then the post.com side. And in some sense, if you were an early mover post the introduction and advent of e-commerce, that moat was sort of inherently there from day one versus legacy players. And it didn't necessarily mean that there was going to be another dislocating technological event 2 years later, right? I do think this is kind of a once or twice in a 50-year period here that we have such a disruptive technological moment in time like the one we're in today. And so for us, I think it's maybe being a little bit right time, right place, and falling on the right side of that moment in terms of when we started building. And additionally, I do think there's a real data moat that gets built alongside the technological moat. And I think that the kind of network effects that are inherent to the platform of having the data and what we're able to then do with that data, such that somebody else that were to come along and try to offer maybe a point solution that could compete with us, even on some newer version of the next model of the AI, et cetera, they wouldn't have the same data set that we have at that point. And ultimately, it does come back to that, because without good inputs, it's kind of garbage in, garbage out, right? And so we do think that that is a strong moat that we are building specifically around data, and that the timing of our launch is fortunate as it relates to the technology that we're using today.
They do say being in the wrong time, being too early is just like being wrong, right? So the right timing is critically important for any startup.
Yeah, and we do think that the why now of this business is really compelling. And not only because of technology, I think that's one leg of the stool, but I do think it's also the sort of massive tailwinds in alts, right? And the adoption and sort of increased penetration, whether that's the high net worth and retail community starting to get really interested in this, 401k participation now being unlocked. We'll see what that looks like and means for this industry. And then I think specifically in the wealth space, the adoption of this technology, at least anecdotally, feels and seems much faster than I would have expected. I think historically we were always told, oh, selling into wealth is hard. Tech adoption is slow, it's lagging. And I do think that right now every firm across industries is saying and asking themselves, should we be using AI? If so, how and where and when? And the sense of urgency is very much there. And so I think those three factors are making for a very compelling why now.
Why now, indeed. All right. So tough questions. So your onboarding pitch is AI native automation that mirrors user behavior. So your system is scraping portals and inboxes. What happens the moment a GP changes their portal security model, their MFA flow or document taxonomy or something like that?
Yeah, great question. So I think a couple things there, right? So the methods that we are using to do this work I would describe them in more in layman's English as dynamic versus static, right? And so just to give an example of that, static would look like having a kind of predetermined scrape of a
If
website.
then else, like you're only looking for certain
Yeah.
issues to resolve.
And similar to how OCR kind of works, optical character recognition, right? Kind of a more tried and true legacy technology that is not bad inherently, right?
Mhm.
But it is something that is very templatized in nature. And so it works well for things that are very consistently the same, day over day, month over month, statements from your phone bill, things of that nature, right? Where things are generally in the same place and you can sort of bucket and band boxes and create templatized extraction of information. Those kinds of methods, I think, largely have failed in this space because this information is highly idiosyncratic. It's not consistent, not only from one manager to the next, right, in terms of the funds and the way they report, but even within fund managers. Sometimes the documents will not look the same, one year as they do the next year, right? And so I think that those kinds of static methods, whether that's for scraping websites and then, a folder moved and the whole thing breaks, right? It's creating more of this agentic style process that is dynamic in nature. And instead of doing a template and following a rule book, it's actually reading.
Mhm.
Like it's actually looking at it the way that a human set of eyes would look at it and say, okay, I know what I'm supposed to be looking for. I'm going to scan this page and find
Mhm.
it. I'm going to read this document. And just because that capital call number moved from page 1 on the bottom to page 2 on the top, because it was a longer write up, well, that's not going to break my ability to find that number, for
Mhm.
example, right? So I think those are some of the things that we've done to solve for what I think has historically plagued the business and made it very hard to deliver technology solutions here.
Thank you for that. So another, what I think might be a tough question. So you say you provide complete back to inception historical processing. Sounds hard to believe to me because how do you validate historical accuracy when different fund managers can rewrite their prior NAVs or they can reclassify feeds or restate capital accounts?
Yeah, great question. So our goal and value prop that we're trying to deliver there is to create a complete account and system of record for the customers that use us and the clients' positions that they want to manage in Bridge, right? And so we're not necessarily representing that we can, fix errored documents that a manager provided in the past, right? If that was what they provided to the client and to the customer. But what we are representing is that when we onboard our customer, we do it in a way that we create that sort of proxy capability to pull the information on their behalf. And because of that, we will pull everything that we find. So the point is, whatever Craig has in Craig's, inbox or portal environment, even if that is funds that go back to 2002, right? Our system will capture all of that information and categorize and structure it the same way that it does information going forward, from the time today that we start working with you now and looking ahead. So I think it's something that we've differentiated on a little bit because we found that to be a really glaring pain point and gap in the market that folks feel like they're missing a piece of the puzzle. Historical cash flow notices, and they want to go reconcile and audit. They're trying to make sense between their current provider and what's in their Adipar account for some clients and what's in their Orion account for other clients, and none of it's making sense. And they don't have a historical easy access point to use for comparison. And so I think that's something that we've solved by virtue of the way that we've delivered our onboarding experience. And I think that folks are finding a lot of value in that.
You talk a lot about PE analyst grade analytics engine, but PE reporting, as we all know, isn't standardized. So who at Bridge is using, or who is Bridge using as a source of truth for gross versus net, fee reported versus fee absorbed, and things like manager defined or IRR methodologies?
Yeah. So first off, it starts with actually being able to accurately pull all of those data points off of a document. That is actually the very first kind of ground zero, right? Because it's one thing just to grab kind of the headline metrics, right? Oh, total invested capital was this, or the capital call money movement was Y. But actually, it's the components of those numbers that matter to ultimately be able to add value on some of the more nuanced questions. From there, it's really us applying, and us being me and IO, applying our lens into that data, knowing what it should look like and what it means when a manager calls something A, B, or C. And that's because, at one point, the funds I used to work at, I was making the quarterly report for the portfolio companies I was staffed on. And I remember what we did, and what we called, and how we thought about the data and performance numbers and all that. So it's really goes back to that point around trying to provide a lens into a system doing work that a human otherwise would have done and imparting that logic into the system. And so for us, I think it's parsing out those data points such that you can create apples to apples comparisons and a data set for reporting that is standardized as best that we can. And, I think it's far from perfect today, right? And some of it, to your point, is just the raw nature of the underlying source of information. But I think we're doing a damn good job, and I'm very proud of the team's work at what we've been able to do to make something that's really hard to understand a lot more digestible. And as we move into phase 2 of our roadmap, which is delving deeper into the help me understand and analyze what we own and not just report on it, that's going to be ever more important.
We're doing a damn good job, if I say so myself.
Well,
I do.
Just to give some credit to the team, they've it's a lean team, and they've accomplished unbelievable things in a short amount of time.
It's a lean and mean team, folks, at Bridge. All right, so Alex, you're selling accuracy here. It's a big part of your delivery, and so, but show me the failure modes. What are the top 3 categories of errors your system still makes today, and what's your current error rate benchmark?
Yeah, absolutely. So the way that we think about approaching errors is we don't think that AI is ready to be an autonomous headless beast, right? Like, we are far from that. And that's not just in financial services, by the way. I think that's true across industries, especially in industries where it's very critical and important data to be right: finance, healthcare, things of that nature. And so the method that we employ is we have a very complex system that surfaces and flags things that may be higher likelihood to be inaccurate, right? And so models, right, they produce output, and we measure not only their accuracy, their actual observed accuracy, but also their confidence thresholds on their outputs. And we have a whole system of business logic and intuition overlaid on top of that that helps with things like, for example, we might create rules in there that underlie some of the model work that say, X plus Y can never equal Z, or A squared plus B squared must always equal C squared, right? And things of that nature. And that allows us, in tandem with a bunch of other machine learning based methods, to flag outputs that are below a confidence interval that we're comfortable with. Our accuracy is well into the mid to high 90s on most data points, pretty much every data point. But from a confidence interval standpoint, things that fall below that threshold will get surfaced for review. And that's a real review by a real human. And so we're not sitting here telling our customer, hey, we flipped the switch on your system and then Bridge just runs and you never hear from us again. There is still a component of service, but it's just flipping the model on its head a little bit. I think a lot of others take a human first approach versus we take a human second approach, but with a very kind of systematic process for servicing those potential errors. And as it relates to the error nodes themselves, to your first question, I think that where we see it the most is on complicated statements that have a lot of different activities being reported in one document, right? Because what is it getting nearly 100% of the time? Simple stuff, right? Capital calls come in, it has dates, it has components, it pulls all of that correctly. We basically don't even have to touch it or look at it or think about it, right? Occasionally, statements will come through that have some combined reporting with multiple different entities and some capital calls and some distributions offsetting those capital calls, and then an account statement value as well, because it's also a quarter end as it happens. And then, sometimes the system might look at that and say, this is what I think is the output. And this is the set of data points that I think should be pulled from here and where they should go. But I'm like 85% sure. Cool. Flag surfaces into our queue. That's where our own sets of eyeballs actually look at that information. And we say, hey, here's what we think it is. And then lastly, and this is important, that all gets pushed into the platform. And we've created a lot of really, really intuitive user functionality to say, hey, you know what? I actually want to recategorize the way you thought of this capital call portion as something else. And it's a really easy drop down, click, save. And that save is really important because that save drives back into the engine and is logged in the system such that next time our system uses retrieval augmented generation, to pull a document for context and prompt, it has an example that overrode whatever we said it was.
Mhm.
And that is just a self-reinforcing iterative mechanism that gets better every single day.
So it should be learning.
It is learning. And
There you go.
I know it's learning because if I looked at the accuracy and error rates from 9 months ago when we first got going to 6 months ago to 3 months ago to even 3 days ago, that trend line is very clear.
Excellent. All right, we're running out of time. Last question. You said your system becomes an agentic proxy for users. So what's your liability model? What if the agent pulls incorrect data, mislabels a distribution, or misses a capital call? What happens?
Yeah. So as I'm sure you would imagine, I would say, but it is true, we have a lot of checks and balances internally for how we know that we got everything we were supposed to get, right? That could be things like, oh, we're able to see across the board that there are, X number of people in a fund, and we received X minus one notices from this thing, and we get a flag that says, hey, we're missing something. Was that a bridge error that it missed something, or did the manager actually not send something they were supposed to send, right? And that's where, again, that second layer of actual human input or review will come into scope if needed. And these are pretty rare edge cases, right? But those are the things that we built in-house to prevent those errors from happening. And so I think, and we have all sorts of checks and balances, whether that's internal stuff, like if we're missing a document or if a number might be wrong, to the audit trail of pushing data via integrations into other systems, right, and making sure that there's a good, strong audit trail there for what got sent into Adapar or into Black Diamond or whatever else it is, right? Mm-hmm. And so I think that from a liability standpoint, we are fortunate in that there's no documents or data really that we're having access to that folks don't want Bridge to pull in to their central Bridge platform, right? We don't touch bank accounts. We don't touch movements of capital, right? We simply touch documents and data from a reporting standpoint. And typically when folks are onboarding with Bridge, it's because they want all of their docs and data across investments, go forward and historical, to be in one place and just easy for them to get to. And so for us, that makes it a little bit easier in that, there's not a whole section of the forbidden page where they don't want us to pull that, right? In fact, it's key to the value proposition that we pull everything.
Well, I hate to say this, but we are out of time. Really enjoyed the conversation. And just so the audience knows, I usually my team usually puts together a list of 20 questions for our guests, and we send it over to them. So they see the questions in advance. And then I usually I'll pick 8 or 10 of them that we get to in the 27 minutes or so. The last 5 questions I asked Alex, he did not see beforehand. I just made them up on the fly because he said he wanted harder questions. And so he answered them all cold. So well done, Alex. Great job.
Appreciate that. And yeah, it's more fun that way. So great questions and enjoyed the conversation. And thanks very much for having me on.
Awesome. Thanks for being here, man.
Hey, it's Craig again. Here are my top 3 takeaways from this episode. Bridge is building an AI-powered platform to automate and streamline the workflows required to participate in private markets investing, which has historically been a highly manual and tedious process. 2, Bridge's approach is to build an agentic system that mirrors human behavior and learning, rather than just building tech interfaces on top of human activity. This allows them to handle the complex, non-standardized data that is common in private markets. And 3, Bridge is focused on solving the digital infrastructure layer for private markets, which they see as an underserved area compared to the emphasis on democratizing access. Their goal is to free up time for investors to focus on higher value activities. All right, we reached the end of the episode of the Wealth Tech Today podcast. Thanks for listening. But before you go, head to our website, edgegroup.com, scroll to the bottom of the homepage, and sign up for our newsletter. Once a month, you'll receive an email chock full of wealth management goodness, news, information, and updates. You will not be disappointed. Thanks again for listening, and talk to you all again next time.